Whereas when I started doing this a few years ago, you'd have to go through investor relations. I can now contact, some of the senior people directly, and they're very, very helpful. So it makes my life a little bit easier. And, it gives people out there a starting point when they're looking at this particular sector. So, I start the due diligence, but, investors should take what I do and then take it a stage further. It gives them a starting point to look at. And that's the sort of the benefit I give people out there.
Okay, so welcome to a new episode of Bitcoin Equities Talks. Today I have with me Anthony Power, which is very out of the box, I would say, personage in the Bitcoin space. Because I'll let you, Anthony, introduce yourself, and for those who doesn't know you, give a little bit about your background and why you're known in the Bitcoin sphere. All the Bitcoin miners are interviewed were like recommending your Twitter feed and your analysis. So I'm happy to jump on the call to discuss all this about you. So please start by introducing yourself.
Thanks for having me. So I'm Anthony Power. My background is the British Army. I was in the military for 25 years. During my time in the military, I qualified as a chartered accountant, and so I've always had sort of like an interest in finance. I retired before COVID, and during the COVID period, we were all locked down for those 2 or 3 years, and boredom set in, and I just didn't know what to do with my time. And I started looking at doing some small investments just to keep myself occupied, get my brain still thinking. And it wasn't the mining stocks; it was more the banks, more traditional stocks and stocks that were in the highest exchanges. So not really speculative investments, more known investments. I'd been doing this for 3 or 4 months, and I had a discussion with a couple of colleagues, and I was recommended to look at a company called Marathon Digital. And so I made a very small speculative trade, bought some shares. I think the share price was just under $5 back towards the end of 2020. And within a few weeks, the share price had like quadrupled. And I didn't know what I was really investing in. So I had to start to think, this is unbelievable. I mean, the banking stocks maybe 5 or 10% a year. And all of a sudden, I'm 400% better off with this mining stock. So I started to look into more detail about Marathon Digital, and I come from the UK, and the UK at the time has a Bitcoin miner, Argo blockchain. So I started to do some research into Argo as well, and it proved to be a very popular share in the stock market in that sort of late 2020, early 2021, just at the start of the bull cycle. And so I started to learn more about Bitcoin mining, and being an accountant, I was looking more at the fundamentals of the company. So going into their quarterly and six monthly updates, looking at their accounts, looking at their monthly productions. All these miners were producing monthly updates for their investors to show what they were doing in terms of mining Bitcoin, whether they were hodling the Bitcoin, whether they were selling Bitcoin. And so I started, I'm going to say halfway through 2021 on Twitter, started to put some basic tables on there highlighting the comparisons of these Bitcoin mining companies. And I started with about 6 or 7, and that'd be Argo, Bitfarms, Hut, Hive, Marathon, Riot. I think that was probably about the ones at the time. And then started to add every couple of months. There'd be another miner, another public miner that I'd be interested in, so I'd add that to it. And at the moment now, I think we're at 14 or 15 miners in North America that I actually do the analysis. And it just grew from there. People liked what they saw. They commented on it, and it was very positive. 6 months into doing this analysis, I was approached by an American Bitcoin mining company called Compass Mining, and they asked if I'd like to do my data, and they would publish my articles. And I said at the start, I said, to be honest with you, I'm an accountant. I don't write. I don't produce articles. And they said, just do what you do on Twitter. We'll help you put it into article format, and we'll publish it, and we'll even pay you for doing it. So I thought that for something I was actually enjoy doing for free at the time, it was a sort of a hobby turned into something a little bit more than a hobby. And it started to grow from there. The analysis got more in depth. We started to look at more fundamental metrics. So I came up with my initial metric was the Bitcoin mined per exahash, and that's a great metric to compare miners of different sizes, because it doesn't matter what size you are, you can calculate that for every miner, irrespective of how much exahash they have. You can work out with their update how much they would do if they just had one exahash of mining capacity. And so that was my sort of first metric. And it's just developed from there. I think I have 5 or 6 different metrics now. I also cover all the sort of the normal financial ratios when the financial updates come out. So every quarter, every 6 months, and the end of years, and sort of do an article comparing the miners, because at the end of the day, there are distinct differences between the miners. Some are very good with production, some are very good at cost, some just seem to be able to get the best energy rates. So there's lots of different factors that distinguish every type of miner. And so I think now, nearly 3 years into doing this, it seems to be getting more and more recognition, as you've alluded to there. I've already been a speaker at a conference in Amsterdam, the Bitcoin conference this year in Amsterdam. I've just literally come back from the AIM summit in Dubai, where I was fortunate to meet 8 or 9 of the and chief mining officers of the biggest miners in North America. So that was a very productive few days in Dubai. And I count now these miners, as I can reach out to them quickly with a question, and all of them will literally come back very quickly with a response. Whereas when I started doing this a few years ago, you'd have to go through investor relations. I can now contact some of the senior people directly, and they're very, very helpful. So it makes my life a little bit easier, and it gives people out there a starting point when they're looking at this particular sector. So I start the due diligence, but investors should take what I do and then take it a stage further. It gives them a starting point to look at, and that's the sort of the benefit I give people out there.
Okay, it's interesting what you're saying, but before we dig into the miners and how you value them and everything you detailed, I wanted first, as a background to the discussion, to get your view about, since you're coming from an accounting background from the traditional financial background, and you're looking at the Bitcoin miner as a business. But if you hear Warren Buffett calling Bitcoin rat poison squared, then where is the fundamental behind that? Since everything you're mining is fugazi, so how do you manage to combine your traditional financial background, where you look at balance sheet, cash flows, etc., with an asset that is just internet money?
Well, we've got to remember, the fact that Bitcoin mining's only been around for the last 13, 14 years. And actually, the public miners themselves, so these are the big companies that mine Bitcoin around the world, they've only been in existence for about 6 years. So this is still deemed to be, it's a new technology, a new space. There are new public miners coming online every other month at the moment. I get requests, probably 1 or 2 requests a month from a new miner asking to be part of my analysis, so that they can be included and get a little bit of sort of I suppose free marketing, free recognition alongside the big miners like the Marathon Digitals and the Right Platforms and the Clean Sparks of this space. I mean, what we've got to remember is with Bitcoin itself, it's a cyclical model. So it runs in cycles. Each cycle is generally about 4 years, and every 4 years we also have a halving, whereby the amount of rewards earned by the miners are literally halved. We're coming up to the next halving in April 2024. So today, every 10 minutes, a miner who is successful is rewarded with 6.25 Bitcoin for achieving the correct number in sequence for the block reward. Come April next year, that 6.25 is reduced to 3.125 Bitcoin. So, next year, there'll only be 450 Bitcoin produced every day for the next 4 years. And that gives you a problem then with the actual supply of Bitcoin, because we know that over the last 2 years, even though when Bitcoin was $69,000 and it dropped down to $15,000 in December, the majority of people holding Bitcoin were not selling any Bitcoin at all. So in the last 2 years, 59% of all the Bitcoin in the market has never moved from a wallet. Never been sold, never moved from a wallet. In the last 12 months, that's over 70%. So over 70% of all Bitcoin last year hasn't been sold. And we've seen Bitcoin this year. It went down to 15,000 in December. It's now rallied by over 100% now, and we're seeing today's price in excess of $35,000. And as we go into the halving, there's no guarantee what the price will be at the halving date itself. The miners would obviously love the price to be significantly higher than it is now, because they know once the rewards have reduced to 3.125, they're going to use a lot more energy to mine one Bitcoin than they are currently doing. It will take them twice as long to mine a Bitcoin, so twice as much energy required. And so to pay for that energy, they're going to require a Bitcoin price that's higher than the current price of 35,000. Now, we haven't got anything other than historic cyclical data to work from. And if you look at the past 3 or 4 cycles, the Bitcoin price has started to move after the halving. So it tends to be 3, 4, 5 months after the halving, we start to see the Bitcoin price move. So from my perspective, as an accountant and looking at cost, all these miners who are preparing for that halving now, these public miners and all miners around the world, should be thinking of 3 or 4 things. They should be thinking of, how do I get my costs down to the lowest possible for mining Bitcoin? How can I reduce my costs now in anticipation that I'm only going to get half the rewards come April, irrespective of whether the price goes up or down? I have to think about the price being stable at the halving point. The second thing is, the energy I pay for now, am I getting the best energy deal, or can I move my miners to another location where I can get a better deal? And miners have shown that where there are cheaper energy, they are prepared to move quite quickly. It's quite a portable industry, Bitcoin mining. We saw in 2021 when China banned Bitcoin mining, those miners moved into Kazakhstan, where I'm actually currently located as we speak today, and also into other parts of the world. Many went to North America as well to set up. So miners are prepared to move when things occur that makes it absolutely a requirement to do so. And by getting that cheap energy, you're bringing that cost down. The next thing they should be thinking about is the fleet of miners that they have. Is that fleet of miners the most efficient fleet that I have at the moment? So, some of these mining machines are lasting 6, 7, 8 years. However, some of the older miners, say like the S9 miners, the efficiency of those miners isn't as good as the most up-to-date miners now. So miners will be looking to make sure that if they've got capital available, and mining machines are quite cheap at the moment compared to other parts of the last few years where they've been really expensive. This might be an opportunity for some of the miners to actually replace some of their machines or grow their hash rate as we go into the halving. So therefore, they're able to get a bit more Bitcoin when it comes to the halving. They've got a better hash rate. The third requirement, because we're going into a halving and there's no expectation about Bitcoin price, these miners will need cash. You're going to have some cash to get through. You're going to have to pay your bills when the price of Bitcoin doesn't change and you're only getting half the rewards. You're going to have some cash to pay for the energy, which is going to be twice as much as it was pre-halving. You're going to have to pay your staff their wages, and there are bills that you're going to have to maintain until the price increases. So you need that bit of cash runway. So all those factors linked to cash, I'd also say have the stronger the balance sheet that you have, the better it is to navigate going forwards. So, just briefly, we've seen a lot of miners in previous years take on significant amounts of debt when the Bitcoin price was high. And some of them realized that was a mistake and have managed to sort of get rid of that debt off the balance sheet. Some miners still have some debt on the balance sheet, and it's caused problems, because when you've got debt on the balance sheet, it means that you're paying interest to a third party for that debt. So you have to pay the interest. You also have to pay the capital repayments of that debt as well. So, that's eating into their cash flow month by month now. So those miners that have got strong balance sheets, very little debt, some cash on the balance sheet, some Bitcoin on the balance sheet, those are the miners that are going to be able to get through the halving with a bit more freedom than some of the other miners who have got debt and have got very little cash at the moment. And we can talk through some of those miners if you want later in the conversation. But from a
Yeah.
fundamental
So
perspective,
so so just come. Yeah. So just coming back to what you were saying, that's why you like the metric. Now hearing what you say, I suppose that's why you like the metric number of Bitcoin mined per exahash, because at the end it sums up how efficient are your machines, how low are your electricity costs, all these items. It's a very good indicator, actually. I've never thought about it.
it's a good indicator, but it's only one indicator. You can't take it wholly in isolation. But what it tells you initially, it tells you which of the companies are able to get the most out of their fleet of miners. And if I look over the last 2 years, there are three companies that stand out from the rest of the crowd. In fact, four companies that stand out from all the North American miners. You're looking at the likes of
Which
Bitfarms,
ones?
you're looking at Hive Digital, you're looking
Okay.
at Iris Energy, and you're looking at CleanSpark. Those four miners just seem to be, on a month by month basis, get more out of their machines than some of the other miners do. But that's only one thing.
And
You also have to look at sort of, how much are they paying for their energy, to mine that Bitcoin. And those four miners have different levels of energy costs. So, it's, as I say, it's great to have one metric, but you can't talk about metrics totally in isolation. You have to look at, a group of metrics.
okay, and you have the electricity costs, which is the biggest chunk of the cost, but you also have like
The biggest.
admin costs and other costs. I noticed also that some Bitcoin miners publish these numbers,
Yeah, all
their
of them do. All of them do to a
electricity
certain
cost.
extent. All of them do to a certain extent. They might not publish
Yeah,
it on a
to a
monthly
certain
basis.
extent,
Yeah,
they're a little bit secretive. Recently, I would say the trend has a little bit changed. Don't you realize?
I think so. If we go back 2 years ago, all the miners that were producing monthly updates would only, at that point in time, would tell you how many Bitcoin they mined, how many Bitcoin they sold in a month, what was their hodl, so how much Bitcoin did they hold on the balance sheet, and what was their operational hash rate for the month. So it's like 4 bits of data. What we're seeing now, 2 years on, and maybe some of the conversations I've had with miners has helped to bring this forward, is we're seeing far more information being provided, and some of the miners, as you quite rightly acknowledge, are showing the actual electricity cost to mine a Bitcoin on their monthly updates. So TerraWolf and Iris Energy clearly indicate on a monthly basis how much each of their Bitcoin costs from an energy perspective, which is great for
Okay.
the retail investors, because then they've got data straight away they can start comparing, very quickly.
So according to this metric, you named these four companies, but when you look at the what the market is valuing, like compared to what you're valuing, is it aligned? Do you notice that the miners that are producing the most Bitcoin per exahash are the ones that are the most valued or valuable by investors compared to their assets or other like traditional metrics? Or there is like a discrepancy? So what's the difference between what you're looking at and what the market is looking and is valuing when you look at Bitcoin miners?
So, there's no, at the moment, I wouldn't say there is a total correlation between how I see the miners, and many other people see the miners, not just my views, but many other analyst views out there, and the mining prices. There are so many different metrics. I'd go along those lines to say that the market doesn't fully understand how to value the Bitcoin miners at the moment. I just don't think there's enough knowledge in the space to fully understand and interpret how each of the miners are performing financially and operationally. So if I was to do my analysis, looking at those miners who can produce the cheapest Bitcoin, because that's a good way of looking at each miner there. Who can produce the cheapest Bitcoin gives you then an indication from a value perspective. And there are a number of miners that sit in that there. I mean, Riot Platforms, not from a mining perspective, but from an energy strategy perspective, have been able to do something that not many other miners can do. They have a fixed price agreement in Texas, and also being part of some of the energy strategies available to miners in Texas, they've been able to do a number of things in terms of not mining and curtailing their energy, switching off their energy, and selling the energy back to the grid, or turning off their machines when the demand for energy is high in Texas, and sometimes during the year when the hot weather's there and people require air conditioning, when people are having breakfast in the morning or evening meal, when the highest domestic requirements used, these miners will switch off. And they get benefits for doing that. They'll get energy credits. And we have seen Riot Platforms in the last 4 months achieve some sort of real astronomical credits. I think in August, it was $31 million just in energy credits alone for their operations at the Whinstone facility in Texas. That 31 million was more than any miner had mined in Bitcoin for that month. So that just gives you an indication. By switching off and reducing their Bitcoin production, they were able to benefit significantly. So are they getting the full credit for that strategy? I don't think they're getting the full credit at the moment for that. You have other miners like Cypher Mining at the moment, I would say, has the cheapest energy cost of all the miners. If you look at what they're paying for their production, so they only pay 2.7 cents a kilowatt hour. That to my mind is probably the cheapest rate I've seen currently in North America. There are probably, there will be cheaper places around the world, in pockets of places around the world. And miners are already looking at moving into these other countries. We've seen Marathon Digital go into the UAE recently and have a joint venture there. Probably the last place on earth anyone would expect the Bitcoin miners to be, in one of the hottest places in the world. Mining machines need to be cooled down to operate, but they've come up with a system there using immersion cooling technology to be able to do that. And the thing about the UAE, just taking this as an aside from what we were discussing, because there is a high demand for energy during the hot months during the day, there is the requirement at night when it cools down, there is less requirement. So what you find is during the day, the demand for energy, and during the winter months in the Middle East, the demand is not as high as the summer. But to have that high demand in the summer, you have to be able to have that amount of energy available. And so when you're not using that whole demand, when it gets cool at night, when it gets cool in the winter months, you have a lot of energy that you can't use. And this energy is perfect for the likes of Bitcoin miners to go in there and utilize energy that nobody else wants to use. You tell me another industry that can switch on their machines or switch off their machines in less than 30 seconds, talking of tens of thousands of machines. No other industry can do that on a supply demand requirement. The car manufacturing country, Elon Musk would not be able to stop his production lines in Texas, if the demand was, required to be, if it was high and stop. So he has to have guaranteed energy to run 24/7. The Bitcoin miners don't need that. They can just switch on and switch off very quickly, very, very quickly. So it really benefits them in these areas. So, the miners will go to these countries where there is, stranded energy that's not being used because, part of the day it's required, but part of the day it's not required. And they can use that. They can, what they call, balance the grid, make sure all the energy is being used, put money back into the economy in these countries. So pay for the energy. And they may be able to get really good deals because they're using energy that nobody else wants. That energy will just be left there, And so, it's the work that the Bitcoin miners do is a really, really productive work. So which other miners have got cheap energy? TerraWolf have nuclear energy. So part of TeraWulf's production at their Nautilus facility uses 50 megawatts of nuclear power. That nuclear power is on a fixed contract of around about 2 cents a kilowatt hour. Now that's cheaper than the Cipher deal. However,
Hold
they're
on, hold on, because last week I was interviewing Carrie Langlais from TeraWulf, and she said it's hydro, it's not nuclear.
using nuclear power at Nautilus 100%, and they're using hydro at their other facility. And so they have the hydro is a higher cost. So they haven't got a fixed price for that, so they're paying a market price. So what terrifies is they have a blended cost of energy. So they have some using nuclear, and that nuclear is a fixed over 5 years at 2 cents a kilowatt hour. That's a given. That's 50
Okay.
megawatts. But they also have about, I think it's like might be over 100 megawatts at their other facility. And that's using the hydro, and they're paying a higher rate. So the blended rate is around just under 4 cents a kilowatt hour, which is still a very, very good rate for a Bitcoin miner at the moment. But I would say
Okay.
that most
So,
most of the miners are paying sort of 4 to 5 cents a kilowatt hour. Those that are not being hosted. So there are a couple of miners that are being hosted. So Bit Digital and Marathon Digital are both have hosted facilities. They don't have the control over the miners. They're using a hosting facility, and their rates are about 6.6, 6.7 cents kilowatt hour, respectively, for those two companies.
okay. So what you're saying, like from your analysis, there is value. The market is not valuing correctly all these miners because when you do your analysis, you see some discrepancies in terms of what the market is valuing compared to what you believe are the fundamental value behind each one of them.
Yeah.
How do you see the halving for Bitcoin miners? Do you see it as an opportunity, or do you see it as a threat? I understand that they're all working to reducing their costs ahead of the halving, but like 1 year from now, if you're holding Bitcoin miners, do you think will be in the money or out of the money?
Well, 1 year from now will probably be about 6 months post halving, so there will be an expectation that the Bitcoin price will be higher than the 35,000 it is today. And we know that the Bitcoin miners didn't switch off in December last year when it got down to 15,000. So we do know that miners have managed to keep switched on during short periods of time. But you're quite right. The halving does give you a more definitive outlook, and the fact that you are now only getting half the rewards, and therefore you need to make sure, for that sort of 5 or 6 months, you've got enough resources to get you through that period, and the expectation then for the Bitcoin price to start rising. What will happen at the halving is, quite clearly, those miners, and I'm not just talking about the public miners, it could be non-public miners, it could be individual miners using machines in their garages, which is still happening around the world. Not as many as it used to be, because the public miners tend to dominate now because they can attract the cheaper energy costs. But the less efficient miners will start having to switch off their machines, because less efficient miners will cost more to mine Bitcoin than the more efficient miners. So, if you're talking about a really modern miner, say like the S21, which Bitmain have just announced in the last few months, that's coming out, and some of the miners have already put big orders in for this new machine. This has got a really high efficiency rating compared to, say, even the early S19 models, which have only been on the market, 3 or 4 years. Their efficiency is nearly 50% better efficiency, which means it's costing you less electricity to mine a Bitcoin. So, those machines, and then say maybe, the S17s or older machines than those machines on out there at the moment, they'll have to be switched off, because it just becomes unviable to mine Bitcoin unless you've got a very, very cheap rate, and we could be talking 2 or 3 cents a kilowatt hour, and you've got an abundance of energy to use there. The less efficient miners start switching off. What happens then is the difficulty to mine Bitcoin actually starts to reduce, because you've got less miners on the global hash rate. And every 2 weeks, the difficulty is assessed, because, Bitcoin's set up to mine one block every 10 minutes. So every 10 minutes, a new block is mined. If the blocks take quicker than 10 minutes to mine, and that's generally because there are more machines being added to the network, the difficulty will become harder. So the next block it will become harder to find that number, and therefore, you know, it, it takes account. It wants to try and get back to 10 minutes for every block. Now, when we have the halving and people start switching off, you'll have the reverse effect. You'll have, it will take miners longer because there are less miners looking for the number. And so what will happen is the difficulty will go down to bring it back down from, say, 11 or 12 minutes to mine back down to 10. And the most efficient miners that are left are the ones that benefit because they start to mine more Bitcoin. Because, less efficient miners carry on, least efficient miners have to switch off because it becomes not profitable to mine, and you have to at least earn a contribution, to actually keep mining. If you can't cover your energy costs, then you have to switch off. If you can cover your energy costs and have a little bit of contribution to cover overheads, you can make a decision to keep mining. But if you can't pay your energy to mine a Bitcoin, then that's the time, as an accountant, that's the time I'd be saying you have to switch off, because it's actually costing you more money to mine than it would be to stop mining, if you understand.
Yes, but you're answering from an operational perspective and a strategic perspective. My question, and I ask this question for every Bitcoin miner I interview, what am I better off today? Holding Bitcoin or holding Bitcoin mining stocks? So in 1 year from now, we all know that the halving is a good catalyst for the Bitcoin price. So we're going to have hopefully a spike in the Bitcoin price that is going to compensate Bitcoin miners for their loss of productivity. But at the same time, the machines are getting more efficient. So there's a little bit of change. But all in all, like if you had to take one versus the other, what do you think in 1 year from now you would be better off just holding Bitcoin or holding Bitcoin mining stocks?
There's an argument for both. I mean, so what you need to remember is that having Bitcoin a definitive asset of value there. So if you a long term hold, the main reason that people actually invest in the mining stocks is because they are, effectively, it's a proxy for investing in Bitcoin. It's quite easy to buy mining stocks online. You can literally choose a stock, and within a number of seconds you can purchase stock online. The Bitcoin mining stocks we've shown correlate quite clearly with Bitcoin price, but they're more volatile. So the volatility of Bitcoin, say against other assets, the volatility of the Bitcoin could be, say, 8%. The volatility of the mining stocks could be, say, 15%. So this is actually quite attractive to investors. You can see the price of Bitcoin rise one day by, say, 3 or 4%, but you can see the price of the mining stocks in one day rise by 25 or 30%. So if the investors can time their purchases and sales in mining stocks, there is far more upside and far more downside if they don't time it well. So there is it is a proxy, it is correlated, but it's more volatile. So that the gains and the losses are far more extreme than the actual price of Bitcoin, and that's what attracts the investors. And actually, we do see some
Yeah,
very well run companies. So
yeah, that's actually the idea behind our ETF, where we build it around Bitcoin equities as a proxy for Bitcoin, because in Europe you cannot have a Bitcoin ETF. Hopefully in the US we're going to have one, but in Europe I don't think we're going to ever have one. And therefore we built our ETF with this idea in mind, to have like a proxy investment to Bitcoin. And you mentioned the volatility, but at the end it's beta. And the way we built our ETF is selecting the top 30 highest betas to the price of Bitcoin. And that's why we have mathematically selected all these Bitcoin miners. But that begs another question. When you look at beta, sometimes beta can come from the business model, and sometimes it can come from the leverage. And you were talking earlier about debt. And do you think, how do you see debt in the Bitcoin space? I mean, in 2022, debt killed a lot of Bitcoin miners because when the price drops and you cannot service your debt, there was a lot of Bitcoin miners who just went bust. But at the same time, if we see a big rally in Bitcoin price and you see these high beta stocks can rally so massively. I remember when I first looked at Marathon, the first run that Marathon did in the years 2021 was just crazy how fast and quick, and therefore you kind of stand out, because you have this massive performance, which brings more money to you, which brings higher valuation to you, which makes you raise money. So I haven't like if you want to be safe and play it like you're managing your savings, of course you shouldn't put debt. But at the same time, if you get it right, you can get such a massive upside that lasts beyond the cycle, that it's not clear for me what's the right strategy for a Bitcoin miners. How do you see it when it comes to debt
So,
and
so
Bitcoin miners?
So Bitcoin miners have three levers, don't they, to raise funds for expansion, for growth, for replacement of machines. And those three levers are: one, to raise debt, which you've articulated there. And in 2021, 2022, when the Bitcoin price was rising, many of these miners went out to the market and got significant amounts of debt, paying interest rates from between 8% and I saw interest rates up to 20% per annum. And when the Bitcoin price is at 69,000, it doesn't sound too bad. Not only the Bitcoin miners fell foul of the price of Bitcoin, but actually a number of the lenders of this debt also fell foul as well, because the lenders who came into this space, again, probably, it's not a mature space, and they were probably underprepared. So some of these lenders went in there with significant sums, hundreds and hundreds of $1 million to lend to miners, and they didn't realize that when the Bitcoin price drops, the price of the machines drops, which were collateralized against the loans they were giving. So, you know, I sort of look at that point there and say, the lenders should be taking some of the blame in that particular space for also not understanding the market. The Bitcoin miners taking on debt when in a bull run, will now realize it wasn't the right thing to do. And some of those miners, and we look at the likes of Bitfarms. If you go back 15 months ago, Bitfarms had $160 million of debt on their balance sheet. Today, that's down to about 7 million. They've dropped over 150 million of their debt in the last 15 months. A phenomenal feat. But they realized probably at the right time to do it. You've still got some miners out there. So Argo Blockchain have over 50 million of debt on their balance sheet. TerraWolf have over 100 million on their balance sheet. Although TerraWolf do have some of their debt is held by insiders in the company, so there is some sort of potential agreements that could come to fruition to resolve some of their debt issues. We've just seen the likes of Core Scientific, who had over $1 billion of debt when they went into Chapter 11 in December 2022. They've just now agreed with all their debtors, and that debt position now looks more like about $410 million. So they've managed to, they manage. It looks like they're going to come out of Chapter 11 in the next 2 months. So before the end of the year, and they'll be stronger for doing that. They've worked really hard. They've driven their costs down now, and I look forward to seeing their next quarterly update in November, which will give me further belief that they're a miner to start looking at again for 2024. I think they've got a really a real opportunity to perform well against their peer group. The second thing that miners can do is they can sell Bitcoin. They produce Bitcoin every month. They can sell it. And believe you me, if we go back 2 years ago, most of the Bitcoin miners were hodling Bitcoin. You look at the last 12 months, most of the miners are selling Bitcoin on a daily basis. So I would say out of the 14 miners that I look at, probably 6 or 7 are selling all their Bitcoin literally every day they mine it. And so they haven't got a Bitcoin balance. But actually, if you look at the way the Bitcoin price has been over the last sort of 12 months, it's probably been a good thing to do to sell Bitcoin when the price has been going down. You've effectively got 3 to 4 miners who I would say have got a good size hodl. You've got Marathon Digital, who've got nearly 14,000 Bitcoin on the balance sheet, along with cash reserves at the moment. They've got something like $620 million available to cover any foreseeable problems as we approach the halving. So they're very well set up there. Riot Platforms don't have as much Bitcoin as Marathon, but have significantly more cash on the balance sheet. So again, another company with over $500 million of reserves on the balance sheet that can be liquidated at a moment's notice. Then you look at the likes of Hut 8. Hut 8 have got over 9,000 coins on their balance sheet. They've been one of the biggest hodlers for the last 3 years. They've only just started selling Bitcoin probably this last 6 months, realizing that the strategy to hodl versus sell, the right strategy would have been a combination of both. So to actually sell some of your production each month would have been the best result if a miner.
But now they're getting merged with
They're going into a
Bitcoin
merger with USBTC, but that's not been approved by the US yet. So it's been approved by Canada. So the US SEC are still going through the process of making sure that everything in that merger is, and bear in mind, if you look at all the sort of like the news of Bitcoin over the last 12 months, I would imagine certain departments are going to be sort of like, when you mention 2 Bitcoin Goliaths joining together, there's always going to be a little bit skeptical as to, is this a good combination? So, Hut 8 and USBTC at the moment are both answering the questions from the SEC. But, I fully expect that to be approved, and they'll join that sort of, towards the high tier of public miners, because they're both valued around about $500 million. So that puts them into a $1 billion miner come the merge. And you've only got the likes of Riot Platforms, Marathon Digital, and Cypher Mining, I believe, have just joined the $1 billion club. Their valuation now is $1 billion. So it's going to be 4 miners with, potentially $1 billion. CleanSpark not too far behind. I expect them to be $1 billion next year because their hash rate's going really quickly. And sorry, going back to we've talked about selling Bitcoin. The third option that miners got is to actually dilute shares, and all the miners have been diluting shares over this last 1 or 2 years. I mean, Marathon Digital and Riot Platforms have done it, to grow to where they are now. They've used their at the market offerings to grow their business, dilute regularly their shares. So, dilute on a daily basis. The shareholders, because they have such big volumes of shares sold on a daily basis, a company like Riot or Marathon can actually sell 1 million shares in a day and it wouldn't even be noticed in the market. So these companies are selling shares to raise capital, to use that for growth. And if you look at Marathon Digital, they've got 25 exahash plugged in. They've got orders for more machines. They're looking at, rolling out in other countries like Africa, Paraguay, as well as increasing their size in the Middle East, in Abu Dhabi. And they've got 23 exahash just in North America. So, these companies, to get to that size, have been selling shares. CleanSpark made no secret of the fact that over the last 12 months, 18 months, they have sold an enormous amount of shares to get to where they're going now. And they're going to be 20 exahash by, early 2024, 16 exahash by the end of the year. And they've got another order in for 4 exahash or 4.4 exahash of the latest generation of S21 miners from Bitmain. So that takes them into that sort of like, top 3 miner space very, very quickly, getting on the tails of Marathon Digital and Riot Platforms. And if you look at, valuations, so, Riot Platforms from a market capital are the largest miner at the moment. They're valued at about 2 billion. They have operationally 10.7 exahash operationally, with another 1.9 exahash to come online by the end of the year. So that takes them to 12.5 exahash. They've got some other businesses. They've got a hosting business, which isn't profitable at the moment, and they've got an engineering business as well. Their valuation is 2 billion. You've got CleanSpark, who've already achieved over 10 exahash, and they're about a third of the value. And so as an accountant, I'm trying to understand, how can CleanSpark be valued at a third of the valuation of Riot Platforms? I mean, effectively, in maybe 6 months' time, CleanSpark will have more exahash than Riot has, even including the hosting element that it has. So, there's probably, the market needs to understand, either they've overpriced or overvalued Riot, or they're undervaluing CleanSpark. I think it's probably the latter. And I can also look at a number of other miners in the same sentiment.
I agree with your analysis. Unfortunately, our time is up. Thanks a lot for your time. It was a very, very interesting discussion. I hope to hop around on another call with you around the halving and see if all these predictions and how all the Bitcoin miners who have prepared and who are the survivors basically of the whole cycle. Thanks a lot for joining, Anthony. And
thanks very much for having me, and goodbye from Kazakhstan.